Howdy, Jacob here. Today we're looking at Blackstone Minerals, ticker symbol BSM. So it's in the oil, gas, and consumable fuels industry. 3.2 billion market cap with just a little bit lower enterprise value. Return on asset invested capital of around 40%, looking fantastic in the most recent year. But even in the last 5 years, we're probably still averaging mid teens. And so revenue side, we're seeing 469 million in 2013 up to 784 million in 2022. But um, that's really just the last 2 years. We see that they own and manage oil and natural gas mineral interests. Company was founded in 1876. It's been around for a minute there. As for dividends, kind of surprising. 2015, was that when? Okay. So they went public again, I presume again, in 2015, and so that's when their dividend started and has been going pretty strong since then. Their margins are stupendously high. Gross margin was 46.6% in 2015 and is now 77%. Again, somewhat cyclical business with inflation being as high as it was the last year and two. I think that that's probably going to be the biggest thing of why we're seeing so much growth here. So I'm going to be running averages here, and it's not going to probably be looking as pretty. But as for now, looks like a just fine company. Shares haven't been going up too much. Probably just stock-based compensation, I presume. Yep. So stock-based compensation is greater than their share repurchases the last couple of years, and so that's why we're seeing a net increase in common stock and shares outstanding. Their dividend is currently paying out 414 million, and on a 5-year average basis, we're probably looking more like 250. And so, to me, especially with the company that has as much return on invested capital as this one, um, and the debt is essentially zero. They're at 4 billion cash, but 10 million in debt. So, great situation for them in respect to debt and this balance sheet. They have 61 million liabilities. That's essentially nothing for them. So that's fantastic from a balance sheet perspective. And again, from a cash flow perspective, it looks like their capital expenditures are really not very expansive. And so, um, I like to say cash cow. And really, the last 4 years, they've definitely been living up to that name. Um, I think use of cash, I'm just going to have to cut this dividend a little bit because although they don't have any more debt to pay down, I would say that I want them to have the ability to buy back shares that are stupidly cheap and then reinvest at rates that can hopefully get them that mid-teens return, which is going to likely outperform what the market can do. So for assumptions, I would say I wouldn't be surprised if this company grew at maybe 2%. I think that it's kind of inflated right now. And so due to that, I'm assuming it might be flat or down the next couple of years, but over a 7-year period, probably average out to roughly 2% a year. A little bit inflated on the P and price free cash flow, saying that at the end of 7 years, they might have a 3% growth rate ahead of them for maybe the next 7 years, but I'm putting a slight premium due to the fact that I think they'll have opportunities to possibly reinvest at higher rates, even though they haven't done that historically. For the margin side, I would say that I'm just going to do roughly an average here. So let's do 45, 55, 45, and 50 with, let's say, 0% change. Because I'm thinking that they'll actually buy back some shares that are relatively in line with stock-based compensation, and then this dividend I'm gonna cut in half because if we're saying about 250 million, you want to average out you really want to balance out what the company's done in the past with what you want them to do. And this company's historically paid out a huge amount in dividends. And so I'm just cutting it in half and saying that, I'm comfortable with their payout being 80% of a 5-year average basis just because they have paid out historically a very large amount. But I still want them to not pay out 100% because I want to have opportunities to reinvest through stock repurchases that are stupid cheap or reinvest back into a business through creating, maybe buying up some land that could be create, oil or natural gas. And so I think I'm comfortable with these assumptions right now. Hopefully this helps in your, hopefully this video helps in conjunction with your own analysis. I think, it's not a bad company. It just needs to fall a little bit more to get to a price that makes sense to me. But in all, definitely an interesting one. So thank you. Have a great day.